Welcome to the Private Practice Survival Guide podcast with your host, Brandon Seigel. I'm a published author, speaker, entrepreneur, and private practice strategist dedicated to transforming the way that healthcare functions. This podcast is all about empowering you to create the change you want to see. Let's dive in. Welcome back to the Private Practice Survival Guide podcast. So in this episode, we're going to continue to look at where you're going, but we're going to focus on identifying your end game and forecasting your final play. And what I mean by this is, we talked about kind of succession, and we talked about the potential of dipping into like, what does sales look like in the investor side? But now where I want to take you is I want to really recalibrate your focus on, if you were to look forward, what would that actual exit look like? You exiting the business in all phases of your involvement in function, involvement in finance, involvement in the vision. And so let's dive in. So one of the things that I'm a big believer in is, in order to quote unquote reach the finish line, we have to know where we're going. We have to identify our final play. In most cases, what's your final play? Your final play is a liquidation of the asset, selling the practice of some kind, typically. And, one of the things that there's a quote by the Chinese philosopher Lao Tzu, and I love it. And what he says is, only he who knows his destination finds the way. And I'm going to say that again. I want you literally just to resonate with this. Only he who knows his destination finds the way. Majority of private practice owners, you know what you're trying to do. You know what your vision is, but you don't know your way. You don't know your destination. All you know is, hey, I want to help. I want to change. I'd like to build a business. But truly, if you could super speed 50 years from now, where would you be? What would be happening? How would it look? And so as we look at this, a lot of you wait too long. I actually think sometimes we should plan our exit before we launch our practice. Does that sound stupid? I think it's so smart. And the concept of it is, if I know my destination, then I'm going to build an infrastructure, fundamentals, foundation that will get me there. And so here are some critical statistics I want each and every one of you to think about. So the stark reality, only 30% of small businesses successfully sell. That's shocking. 30% of small businesses successfully sell. That leaves 70% of small business owners without a buyer or a successful plan for what's next. Unfortunately, only 1/3 of small businesses have a succession plan in place. And moreover than that, 70% of small businesses fail to sell at the time of owner retirement. If you want to retire in the next 10 years and you don't have a written plan, you're missing out. Let's get it on paper. Let's brainstorm it. Let's set it as a mark and a map to the future. And so here's the deal. Nearly 2/3 of family businesses don't have documented and communicated succession plans. And so there's an opportunity cost here. A successful exit plan with improved margins and a 5% rate in growth puts the value of your company after 5 years in the range of 1.6 million if you have the right growth strategy. Experience tells us that results are achievable. At the end of the successful exit planning process, owners can expect to spend far less working in the business, and they should be able to truly double their profits and increase their value threefold. And the reason for that is planning. We know where we want to be. So if I asked you right now, do you want to sell your practice one day? You say, yes. And I said, when? And you say, I don't know. I want you to come up with a date. And what I would say is, I'd rather you come up with the soonest date that you want to sell, because then you can always push it off. What's really hard is when you plan a 20-year exit strategy and you want to exit out of the blue in 5 years. So, for the sake of this exercise, I think you should have a plan that is a 5-year exit, 10-year exit, and 15-year exit. Bring those three exit plans together. And I want you to name, what is that price? What is the value you want to sell for? So you say, you know what, Brandon, I would like to put a number on that. Is it a $500,000? Is it $1 million? 2 million? 3 million? You know, it's interesting because I was meeting with a venture capital firm. I ran into them at a conference. And I remember the venture capitalist had no understanding of our industry. And he thought he did, but he didn't. And I said, so tell me, what are you looking for in your ideal practices to acquire? He said, I'm looking for $2 to $3 million EBITDAs. And I said, are you sure you got the right industry? And he said, what do you mean? I go, the average private practice in the specialty that we were talking about, I said, the EBITDA would be anywhere from 250 to 1.5. That's the range typically. I said, anyone that's above that is most likely a private equity backed firm. I'm not saying they don't exist, but you're looking for one out of what, 100,000 or one out of 10,000, whatever that is. So understanding what your exit is, where you want to go, how much you want to spend, etc. And so what I want you to think about is, start to think about it in this way. How many years of net benefit do you want to get paid to fully exit? And so, for round numbers, let's say that you average $100,000 of net revenue. After everything's paid for, everything, you've got $100,000. That doesn't include your salary because you're working. And you say, hey, in 5 years, I want to be out. And you're averaging 100,000 net benefit. How many years do you want to get paid for the value of your company at that $100,000 rate? 3 times, 4 times, 5 times? If you say 10 times, I don't think you're realistic with what the marginal piece is, because we're going to have to grow your practice a lot to get 10 times. A 10-time multiplier is not common. And I'm just being real with you. It happens, but usually you're in that multiple $1 million EBITDA for a 10x multiplier. And yes, you're going to say, well, 5 years ago, ABA companies were being sold for 15 multiplier. I go, it's not 5 years ago. It's a different market. So understanding your market's really important. So as we look at this, your exit strategy should influence every business decision you make. Who you hire, how you hire, the structure of your business. You will exit your business somehow, someday. So it can only happen, in my opinion, in one of 5 ways. These are the 5 most common ways. Are you ready? Not to sound pessimistic, but here we go. Number 1, death. You die, you've exited the business. 2, disability. You can no longer run the business due to health complications. 3, voluntary sale. 4, retirement. 5, bankruptcy and orderly liquidation. So I want to be crystal clear. In my opinion, there's only 1 out of 5 that we really want, which is a voluntary sale. We don't even want a retirement, because retirement means that you're put against the wall. You can retire after you voluntarily sell, but don't sell because you need to retire. Retire because you did sell, if that makes sense. So when we're identifying our price tag, I want you to look at the benchmarks of the valuation. So we already talked about it. Like, typically speaking in healthcare, and this is just based on present day 2025 numbers, 2026, where we're at, et cetera, in healthcare, I would say 3 to 5 time multiplier of a profitable company with under $1 million EBITDA tends to be a nice range. Are there going to be companies that tell you 2 time? Yes. There are thieves out there, there are pirates, and there are criminals. There is no world on earth that I will ever sell for a 2 time multiplier. And I should never say never, but truly, I'd rather take less net profit each year and have someone run my company. Like there's a point where 2 years of work for 35 years of investment doesn't make sense. In years past, it was this 4 to 8 time EBITDA. And then when you got to a certain point, there was a 10 time EBITDA. It's a little bit harder. And so I just want you to remember that, like in the current market, we're not seeing as many 10s. We're not seeing as many 8s. They're out there, but we're seeing more likely in that 3 to 5 with occasionally 6, 7, 8, and very rarely above the 10 unless you are just a jumbo jack or a unique opportunity. So practices with higher EBITDAs tend to receive higher multiples. And the other thing you need to think about is when I'm selling my practice, the idea of that multiple is that the practice is on an upward trajectory. We're showing 3 to 5 years of growth, and there is a clear opportunity to grow to the next level. So I want to be clear. $1 million EBITDA single location practice might not be as valuable as a practice that is quote unquote $1 million EBITDA, but 3 locations, with each location averaging $333,000 EBITDA. And the reason for that, I want to be clear, is to replicate a $1 million EBITDA by adding more practice locations is rare. It's hard. But if I said, hey, we're $1 million EBITDA, we got 3 locations, each location is in the average of 333. And so what that means is if you were to add 3 more locations, you'd be at a $2 million EBITDA. You get where I'm going? There's a clear map in consciousness. And so one of the things that you got to think about is like a practice with a $1 million EBITDA might receive a 7-time multiplier, but a practice with a $5 million EBITDA might have a 10 to 12 time multiplier. But this also has to do with trends, where you're going and growing, your amount of locations, what the upward trajectory is. So I saw a practice for sale about a month ago. And very transparently, I think that their valuation was beyond fair. What I will tell you is they made the valuation, I don't think they used real numbers. And so I think the valuation was probably fair, but they tried to make it look like a steal of a deal. And one of the things is they padded in profit that wasn't real profit. And when I called them on it, to be honest, they were like, oh, we don't want you to look at our numbers. I'm like, okay, that's fine. But what that tells me is you're showing a higher EBITDA than a true EBITDA. And so you just want to look at that. For smaller medical practices, discounted rates often exceed 20% as their operation hinges on smaller pools of physicians. So this translates to a valuation multiple of less. And so sometimes like a physician practice might only go at 1.25 multiplier only, or 2, or whatever it is. And the reason for that smaller multiplier is it's harder to expand and the revenue growth potential is less. So if I bring you a company that can be 5x bigger in 3 years, it's going to be worth more than a practice that's reached its ceiling. One of the things that we don't always recognize is that selling at your ceiling doesn't mean that you're going to get the best valuation. Selling on an upward trend where you showcase a ceiling can be very valuable. Again, we even look at public companies that are losing money, but they're selling for millions and billions of dollars because the potential trajectory is so great. So when we look at these exit strategy options, I want you to think of the following 7 when you start to think of planning our exit. 1, sale to family members. About 1 entrepreneur out of 4, 24% is what they're showing. So a little less of 1 out of 4, or give or take, will sell to a family member. This preserves legacy. This may offer flexible terms. The cons is you may not maximize the value, the family dynamic complexity. And I want to be crystal clear. If my children were to succeed me in my practice, I'm not going to hold them to market value. I'm not. Like there's a point where that's the whole thing. So I want to be clear. If I'm going to sell my practice to an employee, I am going to give them a discount. Now you may disagree and say, Brandon, like I built this practice. Why should I discount it? I go, well, you didn't build your practice. People with you built your practice. And if people who built my practice they do deserve a discount. And so even when I'm looking at like share value, maybe I say, hey, we're going to come up with the market rate for this practice that someone's going to spend. And we're going to have two different valuations. One valuation if we go private equity, one valuation if we go private. Depending on the discrepancy between the two, that could dictate how we finalize our final value price. Once we come up with our final valuation price, then we're going to give you a discount value on what the share value would be. So maybe it is a 15% discount on share value. So if we're finding a practice is worth $3 million in that kind of averaged between two different buyer pools, maybe we say, hey, we're going to give you 15% off $3 million if you want to buy it. Maybe we'll do the other idea would be, hey, we're going to actually be the financier of that. So maybe it's we're going to sell for 3 million, but we're going to give you a 30-year loan essentially with a 7% and you can pay it off early. I'm just throwing different ideas out there. But there is those opportunities and kind of leading into what I already mentioned. Number two is management employee buyout. Again, they're showing about 23% of practices are selling to their employees. The other idea of this is that ESOP, which I mentioned in a prior episode, and that idea of an employee stock owned practice. And those benefits include, 1042 exchange, you can defer capital gains. There's lots of opportunities when you're doing it in that way. The other idea is strategic sale to a competitor or an industry partner. Again, sometimes we're selling. They're showing about 49% of us sell to, a large majority of smaller private practices are selling to competitors. And so just thinking of that. And so industry adjacent buyers may map the premium strategic partner in that way, and it might maximize opportunities both in terms of your team and patient acquisition, et cetera. And then the fourth one I want you to think about is private equity. So in private equity, we're just seeing that they're offering more. They're building these freight carriers, call them, of different private practices, and they're just able at scale to do things that an individual buyer can't do. So that's something. We're also seeing hospital health system acquisition. We're seeing partial sales where we're just selling portions of the business. And we're seeing a handful, it's rare, but we'll see some IPO. That's more for large multi-location practices. I personally have not seen IPO be as successful as you would think in the healthcare sector of service delivery, but it is an option. So I want you to take a time machine. I want you to go into the future and I want you to draw. Remember that Harold's purple crayon? I always say that. Draw what it looks like. Who's your buyer? Is it a physician, clinician, therapist? Is it a business person? Is it a company? Is it another practice? Is it me? I don't know. Draw it out and let's start that plan. So I want you to be planning minimum 5 to 7 years before your exit. And early planning is a necessity because a best case scenario would be giving yourself at least 5 years to maximize the potential value extracted when you exit. We want to get into that exit strategy. And one of the things I would say is working with a coach that gives you a starting valuation and then gives you that roadmap to say in the next 5 years, here's where we want to go, grow, and these are the barriers you want to be aware of. I think having that exit strategy coach can be very valuable. The biggest mistake owners are making is they're overestimating what their business is worth and they're underestimating what they need to live on after they exit the business. I want to be crystal clear. If tomorrow I said, I'll buy your business, name your price, and for the sake of numbers, let's say you never want to work again. And I say, what's your price? And you say, I want $3 million. And I go, okay, yeah, you're good. 3 million, here it is. 3 million might not last you on your lifestyle. You may not recognize how fast 3 million goes away between paying taxes, Uncle Sam, lawyers, exit strategies, the way that the value of the dollar is going down. So just knowing sometimes an asset that's giving you a little bit is better than a cash out. And so sometimes what you want to do is you want to sell a percentage of interest while you go through that exit, while you continue to increase the value of your company. Um, So in years 5 to 7 before your exit, I want you to conduct a comprehensive business valuation. I want you to develop value acceleration strategies. I want you to begin financial independence planning. And I want you to assess practice management systems and processes that are going to be unique and innovative to make your practice look different. And when I say look different, I want it to function in a way that is innovative and beyond its time, because healthcare follows an old adoption track record where it's the last to show up to innovation. And so figuring that out. When you're about 3 to 5 years, we want to start to implement all of our operational improvements. We want to strengthen our financial performance. We must show at least 3 years of trailing growth. That is crucial. The longer growth we can show, the better. 5 years is ideal, but 3 is at minimum. One of the businesses I just looked at 2 weeks ago went from like 380,000 net profit to 150 to 85. And they're like, yeah, but look at that. You can get back to there. I go, I'm not buying your practice for what it did 3 years ago. I'm buying your practice based on a trend that's going to show me I'm going to make more than you've ever made. My goal when I buy a practice is to make you feel stupid because I've made it that profitable. Truly. And I mean no disrespect, but the idea of investing in a business is a business that's generating more, not less. And no one wants to come in. The only time you want to come in and clean up, quote unquote, and build the opportunity is when I undervalue you. So why take the undervalue? Why not do it yourself? And so that's where we're building that. Consider your expansion. Consider maybe acquiring other practices and rolling them in. Showcase the way that your practice can attack the world of opportunity. So even this standpoint, you come to me like, Brandon, let's just say I'll pick on speech therapy for this episode. Speech therapy practice. You're like, Brandon, I've got a single location. I want to get out in 7 years. I've got 5 full-time therapists, and there's like no one in the market. There's no one to hire, et cetera. I'm like, okay, here's our 7-year plan. We're going to open 5 locations. We're going to open a new location every year for year 7, quote unquote, to year 2 of this transition. We're going to open a new practice every year. We're going to acquire practice. We're going to hit different locations, and we're going to literally take your 5 to 25, because I want to show someone that we can take it from 25 to 50 if they want. That is where we're going to grow. Sometimes that's through acquisition. Sometimes that's through building. That's the game of building and optimizing an asset. See, what you need to recognize is, did you start a business just to be an employee of a business and treat? Or did you start a business to make an impact and grow this thing? So strap on your seatbelt and let's rocket this ship to the next gear. That's what an exit planning looks like. That's how we get to the next year. And when we're like 1 to 3 years before exit, we must have our optimum EBITDA. We must have our optimum cash flow. We must prepare comprehensive due diligence materials, making sure we're using outside people to audit everything. Engage professional exit planning teams if you haven't already. Begin to preliminary identify potential buyers, because I want to be clear. Typically 2 years before I sell, I already know who my buyer is. I could probably tell you right now 5 different companies that may be your buyer. Like, that's the way you have to have a pulse in the market. You have to be able to turn the key and the ignition goes on. And with exit planning, if you want the best, you got to be the best. And you got to know that this doesn't just happen by, okay, I'm ready to sell tomorrow, or I'm tired. No one wants to buy an exhausted practice. When you're exhausted, your team is exhausted. And so I say it this way of like, would a restaurant that just failed a health inspection be worth more money or less money? Less money. Don't create the sales opportunity when you're done with it. Create the sales opportunity when it means something and it's thriving. So the year of the exit, we need to execute our marketing process, negotiate terms of the structure, complete due diligence, have a transition plan for all of our team members. We need to create incentives for our team to want to grow the next 5 years. Every successful exit includes earnouts for both the owner and the key ingredients to the practice. We need to close that transaction and transition. So when we're accelerating our valuation, we want to look at optimizing, maximizing the EBITDA on a high level. If you're gearing up to sell your practice, you want to maximize that. You want to get your payer contracts right. You want to optimize revenue cycle. You want to optimize cash flow. You want to cut expenses. Show that you're at 1 to 10, one full-time to 10 clinicians, physicians, or nurses, practitioners, etc. Stop being an admin sinkhole. This is not going to help. You can do things smarter. You know that idea, work smarter, not harder? This is your time to optimize. Revenue diversification. How are we diversifying locations, revenue, payer mixes, etc.? Cost management. High liabilities can lower practices' net value in a transaction. So you better be debt-free. You better be cash positive. Aim to pay off every ounce of debt you've taken on. Highlight how many years you've been debt-free in that sense. From an operational excellence, we have to build systems and processes, create standard operating procedures based on where your practice will be 5 years from now, not just based on where you were yesterday. This is not only increasing your efficiency, but it assures potential buyers that the trajectory you built will continue. And so we got to also invest in our human capital. This is the people business. So when we're buying a business, I'm buying essentially 3 major categories. The buckets that I'm purchasing, the most important thing is I'm buying people. If you're a private practice that uses independent contractors, you just lost me as a buyer. There's no value. An independent contractor means nothing. It's trash to me because I can't control it, run it, manage it, or roll with it. I want your staff. Quality staff is worth the valuation of a business. I'm buying your revenue, and I'm buying your contracts. That's it. That's what's important. I'll buy your systems and solutions and your branding, okay. But people are important. Human capital is so crucial. So understanding that I can retain your key employees, understanding that they don't need you, understanding the continuity of care, the service quality, and making your practice really plug and play turnkey is crucial. The more stable the income looks, the more value you bring to the table in that sense. And so when we're looking at these KPIs, I want you looking at revenue per clinician, physician, provider, revenue growth rate, payer mix diversity, collection rate, profitability, operating margin, cost per visit, revenue per visit. We're going to break down all that total people expense and that total facility expense. We are going to literally dial it down to cents on the dollar to show trajectory, quarter over quarter, month over month, year over year, several years over several years, to show that you have a rocket ship and you haven't even taken off yet. So we also want to look at our efficiency, number of visits per new patient, the arrival rate, full-time equivalent employees, cost per visit, revenue per visit, patient wait times, scheduled utilization rates, no-show rates, patient satisfaction scores, patient retention rates, clinical outcome measures, staff turnover rates. You get it, right? We want to look at our growth and our market position. Where is the opportunity? Where is that service area? New patient acquisition, referral patterns, brand recognition, et cetera. It sounds funny, but like sometimes one of the mistakes that I sometimes find is people think the value is when they're the only provider in a market. And I'm like, when you're the only provider in a market, that means there's not enough supply. The demand might be high, but usually there's not enough supply. If I've got 15 clinics, I'm going to start buying those clinics. I'm going to start attracting those therapists. I'm going to consolidate and bring them onto my team so that we are winning the race with our patients, et cetera. And so I'm not afraid of being in a competitive market if I can do the job better, plain and simple, if I can attract better people for my team. So when you're looking at this, here are some team members you want. You want an exit planning advisor. You want a business broker, and those could be two separate people. They're going to help coordinate the process, the market intelligence, the buyer relationships, etc. You want an attorney. So we have our planning advisor, business broker, etc. We have our attorney, maybe a healthcare attorney, um, obviously a contract attorney, business attorney. We're handling those legal structures, transaction documentation, regulatory compliance. Then we really need a CPA and tax advisor. We need to make sure we understand because how this money is going to affect our tax status, optimizing tax structures, financial reporting, post-sales tax strategies, because sometimes you don't realize that the sale actually, you'd be better off taking a slow payment than a lump sum. And so just all those pieces are really important to your component. We also want a wealth management advisor. This is a little bit different. So we've got our tax management planner, but then we have our wealth management, creating personal retirement cash flow. This can help you understand how much money you need, your retirement planning, your post-sale wealth preservation strategies. I definitely recommend a practice management consultant to help you with the efficiency side, value building initiatives, and bringing those industry benchmarks. The other thing sometimes we'll use is an insurance advisor, making sure you have the appropriate tail coverage, managing risk mitigation strategies, and any post sale insurance needs related to liability, etc. So, here are some of the exit planning mistakes that I often see. So, critical missteps that are going to destroy the value of your sale. One, failing to maintain clean financial records. Two, not optimizing EBITDA in the years leading up to the sale and allowing it to be a declining uh, cash flow and financial benefit. Inadequate personal financial planning for post sale life. Underestimating tax implications on the sale. I'm going to say that again, underestimating the tax implications of the sale. I don't think people pay enough attention to how much taxes impact our financial sustainability. And so you just want to plan for it. Some of the operational mistakes I tend to see, letting practice performance decline before or during the sales process, not having adequate management and the depth and succession of it, poor documentation of systems and processes, and then failing to retain key employees during that transition. Strategically wise, these are some mistakes. So starting an exit plan too late, anything less than 3 years, in my personal opinion, is too late. Having unrealistic valuation expectations, a lot of the time that comes from the emotional. I put 30 years into this. We are the number one. We're the greatest thing. Everyone loves us. That doesn't mean anything. Money equals money. Stop thinking that outcome equals money. It doesn't. Like, I mean no disrespect, but you got to put it in perspective. The other thing is not understanding buyer motivations and requirements. The only time your emotion aligns with the quality of sale of your practice is if there's another buyer that has the same emotion for it. So I say it this way. Have you ever heard like your house is only worth what someone's willing to pay for it? Well, you love your house and you remember the day that you brought your babies into it and all this stuff. And then someone says, oh my gosh, this is the block that I grew up in. I have to buy that house. There's no price. That's an emotional purchase. So unless you have an emotional purchase, then recognize emotion actually complicates the valuation process. Um, Other things to think about is not understanding those buyer motivations, lack of contingency planning for unexpected events, etc. Economic factors. We need to make sure that we understand interest rate environment affects buyer financing, healthcare consolidation trends, regulatory changes impacting practices values, supply and demand dynamics in your specialty market. As we sit right now, 2025 going into 2026, there's not a ton on the market. So in one aspect, I'll say it's a seller's market. At the same point, I am finding that the valuations are so low, and that is why people aren't selling their practice. And that's where I'll say buyer's market. I can sometimes get a practice for cents on the dollar right now, just because there's not a lot of buyers paying top for private practices. So understanding that is really important. When you're looking at the way that you want to sell your practice and the tax strategies, you want to make sure that you are considering maximum tax efficiency. asset sale versus stock sale. Asset sales may be preferred by buyers who don't need your contracts. Stock sales may offer better tax treatment for sellers. Installment sales for large gains, like those are things that we can look at. Tax deferred strategies, 1042 exchanges for ESOP transactions, installment sales to spread tax burden, charitable remainder trusts for philanthropic goals, etc. Some of the pre-sale tax planning you want to do: optimize entity structure 2 to 3 years before your sale. Consider relocating to tax advantage states. Plan for depreciation recapture on equipment. And so as we're looking at this, you want to make sure you have the personal readiness. You're ready for life after the practice. The emotional preparation, practice ownership often defines professional identity. And so plan for your post-sale activity and purpose. Consider a gradual transition versus a complete exit. Looking at your financial independence planning, calculate retirement income needs. General rule is 75% of current income available post-retirement. Factor in healthcare cost inflation and plan for potential long-term care needs. And so the other thing to think about is your legacy preservation, ensuring continuity of patient care, maintaining community relationships. Consider teaching or mentoring, and like what that wealth legacy looks like for you in that next level. And so as you're looking at due diligence, recognize you're going to need at least, in my opinion, 3 to 5 years of audited financial statements, monthly financial reporting showing trending, detailed accounts receivable aging, payer contract summaries and reimbursement rates, and recognize, are you selling the practice with cash and collections on hand or not? Those are things to think about. Like, so if there's a $500,000 that's waiting to be collected, is that AR that's going to be collected part of the sale or not? Things to think about. Make sure you have the systems and processes, your org charts, your job descriptions, your SOPs, your technology infrastructure documentation, patient flow, scheduling protocols, etc. And then also having it really clear, all of your legal and regulatory compliance data, all available, making sure that you can reassign lease agreements, reassign software terms, reassign any contract that you have, especially if you're doing an asset sale. And so here's the bottom line. Exit planning is business planning. Every decision should consider its impact on your eventual exit. Start early. 5 to 7 years is my recommendation. Value creation is intentional. So focus on the factors that buyers value most. And I got to be honest, professional help is essential. You need to invest in the outcome you desire. And so there's a lot of different ways you can exit. Don't assume there's only one path forward. Think outside the box, because you can do it. Did you know small businesses with a clearly defined endgame strategy from inception achieved a 97% higher likelihood of profitable growth compared to those without specific long-term visions? That's pretty cool. That was McKinsey and Company. And then inspired by Stephen Covey, I want you to remember to envision your end game with clarity and chart your course today. Every step you take shapes a legacy that defines your business's triumph. Thank you so much for tuning into this episode of the Private Practice Survival Guide podcast. In case you haven't done it yet, like us, subscribe, review us, 5 stars, please, and reach out, because together we can thrive, not just survive. Thank you for tuning in to the Private Practice Survival Guide podcast. I'm incredibly grateful to each and every one of you. Exciting news. We're now available everywhere, from Spotify to Apple Podcasts to YouTube, or anywhere you like to listen to your podcasts. So watch, listen, and reach out. If you loved this episode, please drop a 5-star review. It truly means the world to me. Are you looking for more ways to elevate your practice? If so, now is your chance. Reach out, go to my website, or email me at brandon@wellnessworksmp.com. And remember, it's not just about surviving, it's about thriving.